What are discount points or interest rate buy down? Discount points, buy down, loan origination, these are all interchangeable terms that are used to describe you spending money to get a lower interest rate. They go hand in hand. The more money you spend, the lower the interest rate. The less money you spend, the higher the interest rate. For fun, if you're on your computer, go Google Quicken Loans, for example, and search their mortgage interest rates. You'll see in their disclaimers, typically on any given day, they are quoting 2% or more in discount points. That means you would be spending 2% of your loan to get to that interest rate. Well, maybe that makes sense if interest rates are at an all-time historic low and you plan on living in this house for the rest of your life. But what if they're not? What if you refinance? What if you go to sell your house? What if you tap into equity to do a remodel? All of these things would then cause you to restructure and redo your mortgage, and that money you spent on discount points could end up being a waste. So it's really, really important that when you go to lock your interest rate, you analyze to see what is the break even on paying those discount points. Does it make sense to pay points at all? It used to be common practice that every person who got a mortgage paid 1% discount point and never questioned it. Well, times have changed, and it's important that your lender is going through the pros and cons of each and figuring out your long-term wealth plan on if that makes sense for you.